Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Want China interim report. Want China Holdings Limited offers a diverse range of businesses and services across various sectors. Some of the key areas include food and beverages manufacturing and distribution, online trading of food and beverages machinery manufacturing, and related services production of dehydrating, deoxidating, preservative products, packaging materials and packaging solutions, cosmetics and health food product development, and manufacturing consultancy, investment management, information technology, business, and network services, agricultural planting and management, livestock, and poultry breeding, rice flour production. The company serves customers in China and exports its products to North America, East Asia, Southeast Asia, and Europe. Unfortunately, I don't see any extracted summary provided. However, based on general knowledge about China's stock market, here is a possible overview essay. The recent slight increase in China's stock price can be attributed to several factors. One major reason is the country's economic recovery, driven by government stimulus packages and infrastructure investments. This has led to improved corporate earnings and increased investor confidence. Additionally, the Chinese government's efforts to reduce debt and promote financial stability have also contributed to the market's growth. Furthermore, the ongoing trade tensions between China and the U.S. have somewhat eased, allowing for a boost in exports and foreign investment. However, it is essential to note that these factors are subject to change, and the market remains volatile. The primary drivers of revenue growth or decline can be identified through an analysis of various segments and channels within a company. Revenue growth is primarily driven by the introduction of new products, particularly in the rice crackers segment with gift pack products and new launches, as well as emerging channels such as e-commerce and OEM. The snack food segment also experienced double-digit growth due to the success of popsicles and candy subcategories. In contrast, revenue decline was observed in the dairy products subcategory due to a sluggish market, while other segments such as rice products and crackers showed no change in revenue. However, it is worth noting that new product launches have contributed significantly to total revenue, with mid-teen % growth over the past 5 years. Overall, the company's ability to innovate and adapt to changing consumer preferences has been key to driving revenue growth across various segments and channels. Net income and profit margins. A decline in performance. The financial performance of a company has experienced a decline in net income and profit margins over the past few pages. Specifically, net income decreased by 7.8% in page 1 and further dropped by 11% in page 23. This downward trend is also reflected in gross profit margin, which declined by -1.1 percentage points in page 1 and reached a low of 46.2% in pages 15 and 22. The operating profit margin has also suffered, decreasing by -3 percentage points in page 1 and reaching a low of 20.4% in page 23. The reasons behind this decline are attributed to an increase in operating expenses, particularly marketing and promotion expenses for new channels and products, which rose by 10.6%. Additionally, revenue from traditional wholesale channels and modern channels declined, while specialty snack retail experienced growth. These factors have contributed to the decrease in net income and profit margins, indicating a need for the company to reassess its strategies and focus on more profitable areas of business. The company is indeed generating positive operating cash flow, as confirmed by the financial summary and supported by specific data on page 24 and page 25. The latter reveals a substantial net cash inflow from operating activities of Rm 1,305.4 million, solidifying the company's ability to generate sufficient cash from its core operations. The company's debt level has undergone significant changes in the recent period. Non-current liabilities saw a substantial increase of 40%, with total borrowings rising from RMB 4,154.7 million to RMB 4,666.4 million. Similarly, current liabilities also experienced an increase of 9% in borrowings, and short-term borrowings rose from RMB 3,654.6 million to RMB 3,966.2 million. In contrast, interest expenses have decreased significantly by 47.4%. This indicates that despite the increased debt levels, the company has managed to reduce its interest expenses, suggesting a more favorable financial position. The company's financial performance reveals a mixed picture across various segments and regions. On the positive side, specialty snack retail experienced rapid growth, while the rice crackers segment saw a 3.5% year-on-year revenue increase. New products also contributed significantly to the group's total revenue. However, some areas underperformed. Traditional wholesale channels declined by a low single-digit percentage, and import markets faced increased unit costs. Furthermore, Asia witnessed a 13.2% surge in distribution costs, while globally, operating profit decreased by 11%. These results indicate that the company faces challenges in certain regions and segments, which need to be addressed for improved performance. Management's outlook on company strategy. The company is poised for sustainable growth, driven by its rejuvenation strategy and collaborations. The brand recognition framework is expected to fuel future momentum, while organizational restructuring prepares the company for market changes. With sufficient cash and credit facilities, management is well equipped to seize investment opportunities. Prudent financial decisions will be made to navigate changing environments, ensuring the company's continued success. Concerns about inventory buildup or supply chain disruption exist. The company's financial summary reveals several red flags regarding inventory buildup and supply chain disruption. Distribution costs and cost of sales have increased, suggesting a potential accumulation of inventory, page 2. The imposition of tariffs has also led to phased adjustments in the supply chain, resulting in a decline in revenue, page 17. Furthermore, the unit cost of imported whole milk powder has risen significantly due to international trade environment and exchange rate fluctuations, page 22. Additionally, an increase in inventory turnover days from 74 to 80 days indicates potential inventory buildup, page 26. These indicators suggest that the company is facing challenges in managing its inventory and supply chain. That concludes the financial summary for Want China. Feel free to comment below, and I will be happy to answer them when possible.